I want to welcome everyone on to the Follow the Smart Money webinar this afternoon. My name is Brady Walker, and I have been consulting on behalf of John and Pete Najarian for a couple years. So I'm excited to spend a little bit of time with you this afternoon, and I hope shed a little bit of light on the value of adding, options to your arsenal. Um, Most of you are familiar with John and Pete, but for those of you who are not, John and Pete have been involved in options in one form or another, over the last 30 years. They both both played in the NFL prior, both were floor traders. And, the last two companies that they started, Mercury Trading and then Options Monster, which you can read a little bit about here in the description. The last company they previously sold was also sold to E-Trade in 2016. And that brings us today to Market Rebellion, which they have co-founded, which is an investor education company. And I hope that you guys have the opportunity as well to watch them on CNBC. They're both contributors on Fast Money and the Halftime Report every day. So if you haven't had an opportunity to watch them, they are on CNBC on a daily basis. So one question, that I always ask myself is, why is it so important that people add options to their arsenal, right? And add more tools that they have that they can use in their investing. One thing that really, really stood out to me, and I don't think people are completely aware of this, so I just want to take just a quick minute here and go through this with you. For people, that when we're coming up, right, we're always taught, go to work at 18, 20 years old, work hard, for the next 30 or 40 years, contribute to your 401k and retire, right? And then have, your retirement income of what you've deposited. So most people, that's kind of the path that they follow. Unfortunately, I talk to a lot of those people, and the problem is, they wake up at 50, 60, 70 years old, and they just simply do not have enough capital in their retirement or enough discretionary income to where that's a reality. So then people get at a point where, let's say they're 50 years old and they say, okay, I'm going to start making double the contributions into my 401k than I am currently. So I want to just show you a quick example. Okay, if you're 50 years old right now and you're contributing, let's say $8,000 a year, and you currently have $300,000 in your retirement account. Okay, and these numbers are based on 6% before retirement and 4% post-retirement. Okay, if you double for the next 15 years from 8,000 to 16,000, so that's a 100% increase in contributions and that are coming out of your checks, which is going to obviously make you thin there, right? Contributing an additional $120,000 over 15 years, and all the other factors stay the same. The outcome is your monthly gross retirement income will increase by only $934. That's not taking into consideration inflation, right? And taxes. But if you go just the hard numbers, that's doubling your contributions for the next 15 years. Your monthly gross retirement only increases by $934. Something I wanted to point out here. Now, if you increase your return before retirement, okay, we use the number 6% as an example. If you increase your number before retirement by only 3%, so instead of averaging 6%, now you're averaging 9%, okay? And then during your retirement, you increase your income by only 2%. So now instead of the 4% number we use during retirement, you're now at 6%. No extra contributions. So you're not doubling the money, you're just creating 3% more on your money before retirement, 2% post-retirement. All the other factors stay the same. Okay, the outcome gross retirement increases by $3,612 as opposed to the $937. That's just by increasing your average returns by 3% and 2%. And I just thought, that was important to share because I think that will hit home to a lot of people. And I think a lot of people near the age of 50 years old, like I said, 55 years old, they start scratching their head and wondering, if I'm having a hard time off of, let's say, $90,000 a year, when I go to retire and that's cut in half, what's going to happen then? Right? And people say, you know what? I need to learn how to create a better return on my money that I'm working hard for. So I wanted people to understand the value in becoming more educated and more savvy with your money, not only short term, but long term. Okay, which brings us to why we're on this call today. A lot of people ask me, options versus stocks, which is better and why? So I want to take just a few minutes here and go through just some of the basics, ABCs, whether you're on this call and you've never traded options in your life and just considering it and kind of on the fence, you've heard stories, but not really sure what to make of them. Or if you're somebody who's been dabbling in them, let's say over the last 6 months or 12 months, but maybe you're not having the level of success you're hoping to. I want to share some of that, just the ABCs. Okay. First off, with options, one of the most valuable things is leverage, right? Versus no leverage. And one example I'll give that I think is easy for people to understand is you take real estate, right? If I'm going to go out as an investor and I'm going to purchase a house that I would like to flip, let's say I want to turn around and flip this property in the next 60 days. Okay. And let's say it's just for the sake of numbers, let's say it's a $500,000 home. Okay. And I'm going to be purchasing this home, let's say for 450,000, and I'm going to be hoping that I can flip it, let's say for 550,000. Okay. This example, if I borrow $450,000 is essentially the same thing that you're doing in stock. You're having to borrow that full amount of money or invest that full amount of money and put all that capital on the line with the hope of a return. Okay. There is no leverage, right? Versus in options, the easiest way to explain this in layman terms where newer people can understand it, it would be the same equation as going out, tying up a property, let's say under contract, where I put a $10,000 payment down to hold the property and tie it up under contract. In the meantime, I'm now turning around and flipping that property, right? Now, if I turn around and I flip that property, let's say that again, the sell price was 450,000, but I tied it up for 60 days with $10,000 down and had 60 days to turn around and flip that property for 550. Okay, my ultimate profit on this is going to be $100,000, right? And how much did I pull out of my pocket or put at risk to make that 100,000, 10,000, right? Versus the other way, you're buying stock, right? If I want to buy $40,000 worth of shares in a stock, I've got to put $40,000 into that stock versus options. You're normally going to be around a 10 to 1 on your money in terms of leverage. Meaning you can go out and control that same amount of $40,000 worth of stock, purchasing typically around $4,000 worth of contracts. And your upside potential is far more because you're putting so much less money into the trade. And also your downside is so much less risky, there's so much less downside because you're putting so much less into the trade. So that, the biggest thing that I point out to clients, what if you're trading with especially a smaller portfolio, let's say you've got 10,000 or 20,000 that you're trading with in total, right? Leverage becomes even more important, because if you're putting $10,000 into stock and you have a good day, you're not ecstatic where you're jumping up and down. But if you're buying $10,000 worth of contracts, now you're really controlling close to $100,000 worth of shares. And now when you have a good day, you are pretty excited, right? That's one of the biggest values in options versus stocks is you're not having to take on the kind of exposure that you do when you buy stock. And we don't recommend to clients to get heavily leveraged in options. We also don't recommend it to clients to get heavily invested in stock. The only people that are heavily invested in stocks just simply do not understand options because it just doesn't make a lot of sense just from a leverage perspective on being smart with your money and letting every dollar work as efficiently as effectively for you as possible. Secondly, is risk, right? And the unfortunate part is, when you buy stock, there's absolutely no doubt about it, you are at the market's mercy, right? If there's a tweet that comes out, or there's a crisis, or if there's bad news or a bad jobs report or whatever, typically you lose money, right? And there is no control over how much you can lose. Most people don't understand. One big point on this is, a lot of people say, well, I'll control my risk with limit stops and stop losses in stock. What most people don't understand is those are not executable after market hours. So if something has a huge sell-off after market hours, you didn't limit your risk. It'll blow through your stop loss after market hours when you're owning a stock. Whereas in options, using stop losses, limit stops, sliding stops, you can control your risk, right? Because they are executable after market hours. So I think that's one big takeaway. And one thing we really preach to our clients that we work with is, look, when you set up an options trade, right, you set it up to where you know exactly what you're willing to make and exactly what you're willing to lose. You put rules in place that you don't deviate from, which takes the emotion out of it. And going into the trade what you're comfortable with based on your risk tolerance, and you have complete control over that trade 24/7. And I think that's another big factor people need to understand is, you're able to control your risk far more in options than you are in stock. Thirdly, is volatility, which we see a lot of nowadays. That when you're long in the market and you're purchasing just stock, just equities, right? There is no relief on volatility, right? It's up and down and up and down and up and down. What people that are brand new to options need to understand is, when you're purchasing options, volatility is ideal. That's the ideal marketplace for purchasing for purchasing options. Is taking advantage of that volatility. And for people that do have larger sums of money in stock, you can also take advantage of the volatility by hedging your money in your stock account. You can do very basic things like married puts, right, to protect your downside when you're buying stock just long. So that way, when there is a sell-off or there is a crisis, you're minimizing your losses. And let's face it, the older you become, the closer to retirement you become, the more important preservation of your portfolio is as important as accumulation, right? So to have relief on volatility, and then on the other side be able to take advantage of volatility, is key in just what we talked about up front with getting the extra 2 or 3%, right? Small strategies can make a very big difference to a portfolio, not only over the short term but especially over the long term, and just becoming more savvy. um, and then lastly, which I've kind of touched on, the pitfall you run into, like I just mentioned with stocks, is it's one directional, meaning you have to rely on the market getting good news, good tweets, good information, and you have to rely on a market going up to make money. Anything bad happens that impacts the market, you lose money, right? The In my opinion, with the exception of leverage, the absolute best part and biggest value in options is you have many more strategic alternatives available to you as an investor that you just simply do not have in the market. You have more control over your own money. For people that are a little more conservative with larger portfolios, they could trade spreads, right, and control their risk. With people who have larger money, larger portfolios in stock, right, like I just mentioned a minute ago, you could do married puts, right, to protect your downside. For people who have smaller portfolios and they want to focus on accumulation, right, they're buying more straight calls. So there's a strategy, there's a strategic alternative available to anybody. It doesn't matter what the size of your portfolio is, your level of experience, your risk tolerance, or your objectives. There's alternatives for that in options that you just simply do not have in stock. And It doesn't mean you jump into this both feet first, right? And just start swinging for the fences. It's about creating a strategy that is going to be conducive for you and conducive for your risk tolerance, something that you can duplicate and replicate. And the bottom line is, when you look at these four things I just covered, what it's simply doing, like I mentioned, is adding more tools to your arsenal that you can use as an investor to become overall smarter with your money and with your portfolio, which I've always said, if you're going to work 40 years or 30 years, if you're going to work hard to make money to put away to have for your retirement, you need to work equally as hard to learn how to invest that money that you're working so hard for. No one cares more about your money than you. And like I mentioned, leverage is the biggest factor that people get attracted to options. Is, look, I can control so much more for so much less. And that's the great part, is if you're brand new to this, you can buy contracts for $50, right? So you can really work your way into this conservatively and go at your own pace. We have a saying around our office, and I think this is more apparent than ever, especially now, which is Wall Street versus Main Street, right? And we've seen some of what happened recently, with GameStop and these other stocks, and what they've done, what Wall Street has done to kind of shut down Main Street, and how they've done it effectively, unfortunately. The big thing that clients come to us for, right, and understand the value, is information. Look, you can understand leverage, you can have good alternatives, strategies, application. The problem is, if you have lousy information, right, great application doesn't add a lot of value, and vice versa. You can say, hey, I've got great application, or I've got great information, but I got lousy application. I don't know what to do with the information. People that do well in options, they have access to good information and they understand what to do with it. If I'm on the phone with a client that let's say has been trading options for 10 years, they've got $250,000 in their options account, and I ask them, where do you get your information? Doesn't matter the size of the portfolio or level of experience. 9 times out of 10, I watch CNBC, I watch Cramer, I watch earnings, right? And what I quickly point out to the client is, the problem with that is so does everyone else in the country, right? We call it herd mentality. If you're accessing the same information as everybody else, it gives you no edge. And when you're trading options, information is key, because you're trading against other people. Unlike the market, you're completely at the market's mercy. And you can ask yourself, whatever you do for a living, whether you are, you're a mechanic, or whether you own your own company, you're in technology, or whatever it is that you do for a living, there's absolutely no doubt, the better the information that you have over your competitors, the higher probability of success that you have on your time and your money. If you access the same information as everyone else, you get the same as what everyone else gets, right? People that are doing well in options, like I said, they're not relying on late information. When you're getting this information off of CNBC, right, these are controlled releases. They're releasing what they want to release to the public, right? It's late information. By the time you get information from Cramer or CNBC or watch earnings, the problem with that is you're getting it late. You've missed the majority of the spike. So this is going to have very limited potential, right? And the big value of the unusual option activity is you have technology working to your favor. And the way the market runs nowadays, you have to have technology working to your favor to have an edge. You can't rely on the old school methods of just, reading charts and doing technical analysis and watching the news. The market just moves too quick now. The unusual option activity, which is the heat seeker. Okay, this is the name of the algorithm. It's called Heat Seeker. This is what John and Pete own. What this is doing is it's accessing and capturing unusual option activity. So people will ask me, what is unusual option activity? Unusual option activity can be a lot of different things. It could be, for example, a market maker that's manipulating something to move contracts. It could be somebody that's went in and bought or sold a very large block of shares, 3 days ahead of earnings on something. It could be insider ownership that suddenly is buying or selling their own stock in large volume. If you look at this example here, you'll see what the algorithm is capturing, right? It's capturing something that's unusual on a stock, some type of volatility that does not normally happen on this specific stock. And I think that's what is important for you to understand as well. I think where people get caught up and have big swings in the market is they're trying to time it. Why? Because they're trading at a macro level. It's next to impossible to time the market and predict what the market's going to do. What's so effective about an algorithm working to your benefit is all we're doing is trading on a micro level, right? This is microeconomics where it's capturing one specific thing on a stock, not having a direct impact on news that might be released or a jobs report or whatever. It's capturing some type of volatility, which is numbers, right? And we all know numbers don't lie. And what clients absolutely love about what we do is we are then, John and Pete's analysts then vet this data. This algorithm is capturing Monday through Friday about 10 to 40 per day of unusual option activity. So it's capturing typically about 50 to 200 a week. The second step is John and Pete's analysts vet that data to determine obviously what's unusual and what's not unusual. So you've got the technological side, and then you've also got the human side, right? With people that are actually vetting this, prior market makers and analysts that do this for a living. And it's so important. The name of the book is Follow the Smart Money for a reason. Nobody is right every single time. But one thing is for sure, people don't become wealthy in the market because they're wrong all the time either. Following the smart money is never a bad idea, right? And unusual option activity. It's a theory all on its own, but if you can understand it and trade it, it's a theory that is obviously proven to be extremely effective, and give you a higher probability, of success on your time and money. People ask what type of trades are these? When you're doing an unusual option activity, these are typically just straight calls or straight puts. Very simple. They're normally very short-term options, typically just a weekly option. When we make a recommendation to a client on unusual option activity, they're almost always straight calls or puts and very short-term options. They're typically a week out, almost always out of the money, right? So very easy to execute, especially if you're new to options. And when we make these recommendations and send out these alerts, we do include entry points, exit points, rollover triggers, so that somebody who's new to this can follow this, right? It's going to include, target price, time frame, strategy. People, there's different variables that go into this. As you become better at options, right, you want to take Greeks into consideration, implied volatility, et cetera. Then you can get more strategic in your strategies that you use, how far you're putting them out based on your risk tolerance. But the three essentials that the heat seeker is capturing and that we're recommending is target price, time frame, and what type of strategy to use on the trade, which, like I said, makes it very easy to follow for somebody, especially if they're new, right? I always will tell any client that I'm on the phone with that is a beginner, that's brand new to options or has been trading them, let's say, for under a year or two, is you've got to be willing to dip your toe in the water, right? It doesn't mean you jump both feet in. It doesn't mean you move over half of your portfolio in your options account, but you have to be willing to start somewhere, right? You can read all the books you want. You can watch these type of webinars. You can watch videos on YouTube or whatever. The problem is that's all theoretical, right? And like most things in life, you're going to learn this through application and implementation, right? And it's hard to read a book, especially when you're newer, and know exactly what's going to be applicable to me and what's not, right? The mentoring is such a key to what we do as a company. And what I try and help clients understand is, look, is getting educated is something you got to do once. Being uneducated in something is something that you're going to experience the hard way over and over and over. If you're going to get involved in options, it's absolutely worth it to have somebody that can assist you, help you create a systematic approach that's conducive for your risk tolerance, help you get rules in place that you don't deviate from and become a disciplined trader, something that you can rely on and have consistency with, and kind of have a go-to as you're getting in and out of these trades, and then having good information makes it all the better. But when you're new, understanding how to put those two things in conjunction with one another and get the value out of it will be the where mentoring comes into play. Getting someone on the phone with you can help you set goals that are based on your objectives, keep you motivated, give you the right direction, and most importantly, give you the support that you're going to need, not only short term but long term. Like I said a minute ago, don't be afraid to dip your toe in the water. I mean, that's the one thing I'll stress on this today is, I think you all understand leverage is one of the tools you just can't put a price tag on, right? When you can let less of your money do more work for you, than the opposite, right? Having more strategic alternatives, being a better trader, right? Accessing better information, having somebody who has the ability to work with you to help you put a structure in place. I will predict that many of you a month from now, 3 months from now, will be extremely enthusiastic about the potential that you'll have as you start getting more versed in this. You'll end up hitting yourself on your forehead and say, you know what, I can't believe I wasn't doing some of this stuff years ago. It just made no sense. Especially protecting my portfolio, that's a no-brainer. But you only know what you know, right? If you want to change your portfolio, you change your habits, you change your knowledge, right? And you've got to start somewhere, and you got to be willing to take the first step. I urge you, we are running a promotion today, and I urge you to call in. This will not be a high pressure situation. This is somebody that will have a conversation with you, ask you a few questions, um, and be able to make a specific recommendation based on what your objectives are. So I urge you to please call in. We're going to be running a promotion with three free one-on-one sessions with one of John and Pete's traders at no charge for the first 25 callers. So I urge you, the only way you can change your situation, like I said, is changing your habits and taking the initiative to pick up the phone and call. You don't want to always be on the fence and wondering, what could I be doing with my portfolio that I'm not doing now? Pick up the phone and find out. Just have a conversation. Like I said, there's not going to be any pressure involved. We're not here to talk you into this. But pick up the phone, call in, have a conversation with one of John and Pete's strategists, and see what we can do to best help you. I appreciate your time. I hope this was informative, and I wish you the best of luck in your options trading.